Hello, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. Today's video is going to be on one of my favorite investing subjects, investing in growth stocks. And it's very important to point out that as a value investor, commonly known as Mr. Valuation, valuation is just as important investing in growth stocks as any other stock. However, there is significantly more risk investing in growth stocks, which makes valuation even more. The growth stock I'm going to cover today is Ulta Beauty, Inc., the largest retailer of beauty products in the nation. And as I mentioned in the written portion, Peter Lynch taught me to invest like this. He often talked about monitoring the shopping habits of his family and then evaluating the stocks after he saw his family purchasing certain things that they really liked and enjoyed. And my wife and daughter went shopping recently and came back with a big bag full of Ulta Beauty products. So I brought up the FastGraphs, and what I found was a quintessential example of a growth stock. And what I really want to focus on here is what gives a growth stock a higher valuation than a slower growing company. That's a primary point that I want to try to convey with this video. In order to understand why growth stocks command higher current valuations than slower growing stocks, all we have to do is look at the company's earnings growth history. So we've got Ulta Beauty here, and what I have is a plotting of the company's adjusted operating earnings per share. And this is the key to growth stocks. In fiscal year 2009, which ends in January, I might point out, Ulta earned 44 cents a share. But look at how the earnings grew to 66, $1.20, $1.90. Last year, they earned $6.52. Remember, their fiscal year ends in January 31st. The point being is that their earnings by 2016 were more than 10 times higher than they were in 2009. This is the power of high growth. This is the power of compounding. And when you bought the stock in 2009, the company was earning 44 cents. By 2017, the company's earning $6.52. That's more than 15 times as much earnings in 2017 as you originally bought in 2009. And that is where the growth comes from. So the reason you can pay a higher premium for a growth stock is because they're generating such a higher magnitude or level of future earnings than a traditional stock. Let's look at Johnson & Johnson, which also deals in certain cosmetics. Obviously, they have a lot of other businesses, but this is the AAA rated, one of the premier dividend stocks in the world. And what I want you to see here is the real difference. So I can do the comparison fairly. I'm going to take dividends off. And what I want you to see here is that Johnson & Johnson also has a very consistent record of earnings growth. It's the magnitude, it's the slope of this line that really differentiates the Johnson & Johnson from a Ulta Beauty, for example. And you can see it here just by looking at growth. Johnson & Johnson actually had 10 times as much earnings as Ulta Beauty did in 2008 and 9. However, by 2016-17, those earnings had not yet even doubled, where Ulta Beauty has gone up 15-fold. That is what separates a growth stock from a pure dividend-paying blue chip stock. And it's the growth of earnings, it's this development of the future earnings that really gives the company its value. So in order to measure that, let's do something very interesting here. Let's look at Ulta Beauty now, but let's add monthly closing stock prices, because there's some very interesting aspects of a growth stock like this. If I put monthly closing stock prices on the graph here, you can see that Ulta Beauty has grown at a very rapid rate, but more importantly, you can see that the stock price tracked that. This orange line is a PE ratio of 31, and that would be a PEG ratio of 1, or a PE ratio equal to the 31.1% growth rate. And you can see clearly how the stock price went where the earnings went, and when it got overvalued, it came back into value, and when it became undervalued, like it did in 2014, it moves back to value, and then above, and then back to value. Now, recently, the stock has had poor performance in 2017. It had a peak price of $315, actually was the high in 2017, and it currently trades around $226. But keep in mind, the company has no debt, it has a pristine balance sheet, and it has an excellent growth rate. What I think is also interesting about this particular stock is when I look at GAAP earnings, these are operating earnings. When I look at GAAP earnings, I also see that the company has a very consistent record of growing GAAP earnings at a very high rate. So there's not a lot of accounting shenanigans going on with this company. Although the company doesn't pay dividend, the ability to generate cash flow is also very important. As you can see, Ulta Beauty produces a very high level, over 18% growth in operating cash flows. And free cash flow, again, it's a non-dividend paying stock, but free cash flow is also important. And the company has grown free cash flow very nicely. I want you to notice an acceleration in growth expected here more recently. Now let me talk a little bit about valuation and evaluating growth stocks. I put monthly closing stock prices back on the graph, and I'm looking at adjusted operating earnings again. I want you to notice that on September 30th, 2008, Ulta Beauty was commanding a PE of 29.3. Their growth rate was 31.1%. So the PE of the orange line is a PE of 31. So it was trading just slightly below. Its PEG ratio was slightly less than 1 at this point in time. But what I want you to notice is the company grew earnings at over 30% a year, and had you held it through yesterday's close, your total rate of return would have been 35%. You'd have turned $10,000 into $170,000. That's a 17-fold increase in your money because the company generated a 15 to 17-fold growth in its earnings per share. But here's the point. This is all about growth. That's all you have. There are no dividends. You can see there's no dividends listed on the stock. It's purely growth. So all of your return comes from capital appreciation. And I do want to add here that the recent weakness in Ulta Beauty, in my opinion, stems from the fact that the company had become so dramatically overvalued in 2016 and 2017. So this, to me, was an overshooting of the reversion to the mean. And I think the company's back on its way to moving back into alignment with its intrinsic value based on its earnings. However, here's where the Ulta Beauty growth story gets a little tricky. Going forward, there are 25 analysts expecting a good year this year of over 28% growth. Remember, their quarter ends today, actually, January 31st. So it'll be about 45 days before we see the quarter. But then they're estimating 17 and 25%, but notice the number of analysts drop off. So we've got a growth rate averaging 21.2% going forward, which would indicate a mid-double digit, 9.5% rate of return if you bought the stock here and these earnings actually manifested. If you looked at the normal PE, and this, I love this graph because you can see this company has historically commanded a PE over 30. Now, in my opinion, and I think this is critically important, this PE ratio valuation, now, if the company did grow earnings as expected, and it did trade at this 36.6 PE ratio, you could see the rates of return could be in excess of 40% annualized over the next 2 years. However, here's a problem with that. When you actually look at the long-term estimates even, the analysts are looking at 21%. There's 7 analysts forecasting a 3 to 5 year growth rate. When you look at the shorter term frame, there's a few more analysts forecasting 21% growth going forward. So even if we assume that these estimates have been correct, and by the way, looking at the analyst scorecard over the last 5 years, the analysts have been very accurate forecasting this company. So, that at least gives me some comfort that there may be some credibility in these forecasts, but you still have a double-digit rate of return. And this is why I say Ulta Beauty is currently moderately overvalued. The reason for it is because the company's future growth is expected to be significantly slower than its long-term growth. So let's analyze historical growth for a minute by going to the historical growth tab here and bringing up this tab. This shows me the historical growth rates of the company since it's been a public company. Now, I've been focusing mostly on this 9-year growth rate because when companies first go public, they come out with a financial statement, but they usually show negative earnings growth the first year. So I'm looking at as the company's been functioning as a public company, and you can see the growth rates have been in the 30 and 40% rate, but they've slowed down, although this year they're expected to be over 30%. So, when you're looking at the company's future earnings growth, the company is expected to continue to grow very fast, and that would make it an attractive investment. However, at the same time, I don't consider this company to be cheap, because if I pick a slower growth rate, if I pick a growth rate like 24%, that changes the dynamic a little bit. Nevertheless, I think the point is I do believe the company is going to continue to grow. And part of the reason for that is when I looked a little deeper, when I go into fund graphs, the fundamental underlying numbers, and look at certain things, like there's been a lot of discussion about their profit margins shrinking. This is a long-term look at the company's gross in red and in royal blue, their net profit margins. The company generates 30% plus gross profit margins and brings about 6 to 8% of that down to the bottom line, as you can see. Now, if I draw this as a line graph, I think you get a little better perspective. The company's margins have actually improved. Their net margins have actually improved relative to what they were back in 06 and 07 and 08. And of course, they went public right in here. So they've got good, stable net margins. And if I look at the last quarters, there's a couple of other interesting aspects of this that I think are worth looking at. If I look at the last 12 quarters, you can see that their margins have shrunk a little bit through October of last year, but they're still in the 7.8% range. So I don't see any tremendous weakening in the company's gross or net margins currently. It's a very stable business. The company, as I pointed out in some of the written portion, the company has had a very consistent operating history. They're fully involved in the online marketing, etc. So the company is very well positioned. It's got a great niche. It's an extremely fast-growing company with a very strong balance sheet, generates good cash flows, and is very undervalued relative to historical growth. But as we shorten the time frame, I do want you to notice the growth rate has been slowing down, so valuation doesn't look as good. But keep in mind, you can overpay slightly for a company that's building earnings as quickly as Ulta Beauty's been building earnings. Now, as promised, I want to close this video by talking about risk a little bit. If we go back to September 2008, we can see that Ulta was trading at a 29 PE. That's slightly less than it's currently trading at now. It's currently trading at a blended PE of 27. But the company grew by 31% a year. So when you look at the track record, again, I mentioned this earlier, it gave you a 17-fold increase in your rate of return. And that's the excitement of growth stocks. They can generate returns that are so much higher than, I'm going to use a slightly different time frame here, but here's the performance of Ulta Beauty from January 31st, not September 2008. And you can see your money went up about 15-fold. And you compare that to the S&P that would have turned 10,000 into 22,000, turning 10,000 into 148,000 is obviously dramatically different. In order to illustrate the risk of investing in growth stocks, I want to take a look at the company Stericycle Inc. This company also has a pristine historical growth rate, as you can see here, up through 2014. I want to emphasize that. It looks just like Ulta Beauty did. And when you put price on the graph, you can see that the price tracked the earnings growth, and it did command a premium PE ratio during this time. But the point is, this stock also generated very significant rates of return for its shareholders over this time frame. A $10,000 investment in December 31st, 1998 would have turned that 10,000 into over 319, almost 320,000. That's a 24% compound annual rate of return over this time frame. Ergo, the exciting thing about owning growth stocks. But I want you to see, very similar to what we saw with Ulta. The company earned 20 cents in 1999. It earned $4.27 by 2014. That is incredible growth. And the growth is what created the economic value. But watch what happens or can potentially happen to a growth stock when earnings growth slows down. They come into 2015 and earnings growth slows down to only 3%. And you can see the stock price started to show some stress. I take that out one more year into 2016, and we see another 3% year, and now we see a very strong reaction into the stock price. Bring it up through 2017. Now you see some interesting things here, and I want you to notice this very quickly. I'm going to go ahead and go out all the way here so you can see the full graph. What is really evident when you look at this graph is this flattening of growth here. Here we have 18% growth. I drop this to a 6% graph, we have 4% growth. I drop it to a 5% graph and we only have 2% growth and the initiation of a dividend. So clearly what this is really all about is growth stocks are great while the music's playing. It's like musical chairs. But when that music stops, like it did in 2015 and 14, you better have a chair. And the chair has got to be, the valuation and the earnings in alignment. And there was no chair here. And obviously, all that you saw happen here in the last year's results, if I go back to the peak here from July of 2015 to current, investors in Stericycle would have lost almost half of their money over this period of time, all because earnings growth stalled. This has been Chuck Carnival saying I hope you enjoyed this video on growth stocks. I hope you appreciate the opportunity in investing in growth stocks as well as the risks. Thanks for watching.